Oh, hello. Did you know that if you had $1,000 today and you put in $100 every month, and if you were able to invest that and average a return of, let's say, 15%, after 40 years, the total amount you would have invested is $48,000, which may seem like a lot. However, the total of your investment after 40 years would be $2,723,007. Conversely, if you had $1,000 or $1 million today, in 40 years due to inflation, that would be worth $306,556. So it's important to not only grow your money, but to protect it. So how do stocks work exactly? For instance, the stock market, as you may have heard. Essentially, a company decides to go public, which allows you to be part owner in their company. So when you buy a share of stock, you're actually buying a piece of the ownership of that company. So as the company does well, as their earnings and sales revenue goes up, then the stock price goes up because they become more desirable. And that's better for everyone. So this is a stock chart. It's very easy to find. Google, Yahoo, they each have their own version. So this right here, that's the stock price. That is what it's currently worth. One share is worth $130.56. If you bought it, let's say 10 years ago, it would be worth roughly $20, which means if you bought one share at $20, you would have made $110.56. Now, if you buy 100 shares, then that is multiplied by 100. So these little numbers here, those are various indicators used to determine how well the stock is doing. This is an indicator of the Dow and NASDAQ, which are indexes. So the Dow takes the 30 largest companies in the US, tracks their progress, and averages it out to see how the stock market is doing overall. And what that will look like is something like this. This is the stock price history for Apple. So it goes along here, then roughly about 2008, stock market receded, there was a crash, it goes up, various fluctuations depending on how desirable Apple is, and currently they're an all-time high. So the main concept behind buying stocks is to buy low, sell high. Everyone's heard that. However, how do you go about doing that? How do you know when a stock is low and how do you know when a stock is high? One way is value investing, which was coined by Benjamin Graham, a great investor, and the mentor of Warren Buffett, who is now, I believe, the third richest man in the world. So value investing looks at a company and then decides, you know what, based on the stock price, I'm getting a bargain if I buy this company. Growth investing says, wow, look at that, Apple and Netflix are shooting up. I'm going to try to catch some of that momentum and sell higher in a few months. So various different investment strategies are involved just using these two simple ideas. Another way of analyzing stock is purely on technical data. How much it sold recently, what the old stock price was, price to earnings ratios, and other various accounting terms. And once you decide that a stock is, in fact, a good buy, and you believe it will grow, and you'll be able to sell it for a profit, and then you go to a broker. There are full-service brokers, however, due to the internet, they are less valuable now. A full-service broker will call and say, hey, you should buy this, or hey, you should sell this because it's going down. However, discount brokers online, such as Scottrade, Ameritrade, E-Trade, or the new Robinhood, if you have an iPhone or an Android phone, will let you do it at a much lower price, but you have to do all your own research. The stock market allows you to participate in the companies you love, to grow your money, and to take part in capitalism, that glorious structure. And that is why you should invest both your time and your money in the stock market.